Relevant costs are a fundamental concept in management accounting and play a critical role in commercial and operational decision-making. Within the program framework, relevant costs are future costs that differ between alternative courses of action and are directly affected by a specific decision. When evaluating options, managers must focus only on costs that will change as a consequence of the decision being considered. Costs that remain unchanged regardless of the chosen alternative are classified as irrelevant. By concentrating on relevant costs, organizations can make more effective decisions regarding pricing, product mix, outsourcing, resource allocation, and investment opportunities while maximizing profitability and organizational value. A key characteristic of relevant costs is that they are future-oriented. Historical costs, often referred to as sunk costs, are not relevant because they have already been incurred and cannot be altered by current decisions. For example, if an organization has already spent money on equipment, that expenditure should not influence whether a future project is accepted or rejected. Instead, managers should focus on future cash flows that will arise as a result of the decision. This distinction is important because decision-makers may sometimes be tempted to consider past expenditures, even though such costs have no impact on future outcomes. Relevant costs must also differ between alternatives. If a cost will be incurred regardless of which option is selected, it is not relevant to the decision. For instance, fixed costs that remain unchanged in the short term are often irrelevant when evaluating special orders or product mix decisions. Conversely, variable costs that increase or decrease depending on the chosen action are generally relevant. Management accountants identify these differential costs to determine the true financial consequences of each alternative. This approach ensures that decisions are based on incremental effects rather than total costs that may obscure the economic reality of the situation. Opportunity costs represent another important category of relevant costs. An opportunity cost is the benefit sacrificed when one alternative is chosen instead of another. Although opportunity costs do not always involve actual cash outflows, they are highly relevant because they reflect the value of foregone opportunities. For example, if scarce machine capacity is used to manufacture one product, the contribution that could have been earned from producing an alternative product represents an opportunity cost. Recognizing opportunity costs helps managers evaluate resource allocation decisions more effectively and ensures that limited resources are directed toward their most valuable uses. Relevant cost analysis is widely applied in short-term commercial decision-making. Common applications include special order evaluations, make or buy decisions, outsourcing assessments, product discontinuation decisions, and product mix optimization under limiting factor conditions. In each case, managers compare the relevant costs and relevant revenues associated with alternative courses of action. By focusing on incremental financial impacts, organizations can identify the option that generates the greatest contribution or economic benefit. This approach simplifies complex decisions by eliminating irrelevant information and directing attention toward factors that genuinely influence future performance. In conclusion, relevant costs are future costs that change as a direct consequence of a decision and differ between available alternatives. They form the foundation of effective management accounting and support rational decision-making across a wide range of business situations. Relevant costs exclude sunk costs and other expenditures that remain unchanged regardless of the chosen option, while incorporating differential costs and opportunity costs that influence future outcomes. By applying relevant cost analysis, organizations can evaluate alternatives objectively, allocate resources efficiently, improve profitability, and support strategic objectives. Consequently, understanding relevant costs is essential for effective commercial and operational decision-making within modern organizations.